This is Kali Persall, editor of Institutional Investing in Infrastructure, and I'm here with Tony Catachanas, founding partner and group CEO of Peak Partners. And we're going to talk about the industrial middle market today and its intersection with infrastructure. Before we get started, though, Tony, would you like to just kick us off with a few words about yourself and the firm?
Sure. Thanks, Callie. Thanks for arranging to talk today. I am, as Callie mentioned, the group CEO and co-founder of Tower Peak Partners. Tower Peak is a global private asset investment firm. The firm was launched formally in June of 2024, and we are very much oriented towards delivering institutional investor mandates. We are supported by a group of pension insurance companies, a few family offices, and a few sovereign and multilateral institutions. We invest capital across various industrial value chains predominantly by way of private equity investments, infrastructure investments, and we are developing our capabilities in the natural capital space and in intellectual property and rights, which will be a novel area that we're very excited about.
Fantastic. Thank you so much for being here today. So, when we talk about the industrial middle market, how do you define that? And what are some overarching trends that you're noticing within that?
Where we spend our time is on looking at industrial companies that operate in industries that are typically capital intensive. And what that means is there is a different shape or S-curve shape, so-called S-curve shape in industrial companies than there is in other sectors such as tech, healthcare, consumer related industries. So we're in the business of supporting heavy industry and supporting the deep structural changes that have been brought about by virtue of the industrial transition. So we work in energy, we work in chemicals, building materials, waste, water management, transportation, and associated infrastructure. And again, we do that globally. So the middle market for us is very, very clearly defined. Typically, companies that range with an enterprise value ranging between $50 million and about $1 billion. And of course, that range will vary profoundly depending on the jurisdiction we're talking about and the spread of companies that exist in different markets around the world. The goal fundamentally is to support, again, the industrial transition and to help, different industries, heavy industries, reduce their emissions, decarbonize, and of course, align with the climate change prerogative or deal with the climate change prerogative.
All right, thanks so much for covering that. Can you just tell me a little bit about the regional preference in terms of trends that you're seeing for the industrial middle market?
We've identified that there are about 4 million companies around the world that are engaged in industrial activity, of which about 3.4 to 3.5 million are actually located or headquartered in Europe or the United States and Canada, so North America. We've noticed in particular over the last 10 years a lot of transatlantic activity, in particular North transatlantic activity, meaning European companies seeking to expand overseas. And the first place that they start to do that is in the United States or Canada in North America. And likewise, we see North American companies trying to expand internationally. And the first, port of call for that is in Europe as well. And so there's a lot of that crossover on the northern side of the transatlantic. And occasionally we see more and more increasingly European and North American companies looking south to Latin America in particular, some going east, but fewer. And so those expansions of what we call middle market companies in the industrial world tend to be very, very active on a cross-border basis. And European and North American companies tend to dominate that activity on that cross-border basis.
That's very interesting. Thank you. You mentioned a little bit about multinational industrial companies addressing climate change prerogatives. I was just wanting to see if you wanted to expand on that point, maybe talk about any changes you're seeing in how they're approaching infrastructure sectors or heavy industry sectors as well.
One thing we've noticed is there's been an increasing interest by large multinational corporations to start deploying their balance sheets by doing investments. And they do that by approaching people like me to do industrial JVs, strategic investments. One of the things that we've noticed as well is that with respect to the climate change prerogative in particular, there are essentially three ways that a large multinational industrial company can address the so-called transition prerogative. And the first way is typically by acquiring and offsetting existing emissions. And the way they do that is typically by buying voluntary carbon credits or increasingly by deploying capital directly into acquiring land for the carbon sink value of that land. The second way that they address the transition is typically by looking at their legacy activities and its carbon footprint, its emittive activities, and trying to find a way to reduce it by either building new infrastructure that's more sustainable or by finding ways to mitigate, the emission or the carbon footprint of that legacy activity. And of course, the third activity and the third way that they typically address the transition is by looking to acquire typically middle market companies and sometimes very early stage companies that are innovative, that have developed a new technology that is more sustainable and can help them become more competitive and address again their transition prerogative. Typically, that transition prerogative, remember, for many large multinationals, is imposed by shareholders. So they have a mandate, imposed by shareholders to do something about their carbon footprint, about their emissions, and their core activities. And so they are very active in doing so. So we've been seeing a lot of that activity. As a matter of fact, the bulk majority of the capital that's been going into the so-called energy transition over the last 20 years, about 75%, according to PitchBook and Bloomberg data, seems to have come from multinational industrial balance sheets as opposed to funds. What we have been finding, conversely, on the fund side, is that we've amassed a lot of capital on the fund side in infrastructure funds in particular. We haven't seen a lot of that capital go into so-called developers, producers, or operators of infrastructure. We've seen it more go into the assets directly, the projects, and typically by way of some form of non-recourse lending activity or by equity activity, again, at the project or the asset level. We're finding that, finding good investments to make within that context is becoming increasingly competitive. And that is a function in part of the fact that we need more capital, being directed into what we call DPOs, the developer, producers, and operators of infrastructure. And a large part of that is, of course, the middle market in industrial activity. And so the big multinational corporates recognize that. I think institutional investors need to recognize that too. And you find a lot of synergistic value for institutional investors in going into the industrial middle market and sitting alongside large strategics or multinational industrial groups.
So you mentioned infrastructure funds, and there's been a lot of talk about dry powder being available right now. What are your thoughts on that? What are you seeing?
There has been, a growing concern around dry powder being pent up in private asset funds in particular. And when you look at the private market landscape, I found a statistic the other day actually that was trying to look at the cumulative or the accumulated dry powder as at June 2024 last year, as published by S&P. And I think they put the total number at $2.6 trillion, globally. And that's an astonishing number. That's a huge amount of money currently lying in funds, and in the words of S&P, sitting idle, which I found absolutely incredible. And when you look at the breakup of, that statistic, about a quarter of that is in infrastructure funds alone, which says a lot. Again, relative to what I said before, there are a lot of projects out there, a lot of funds that are oriented towards projects. And of course, a lot of capital is flowing or attempting to flow into projects. There aren't enough projects available. And so we should be redirecting that towards the companies that built the projects rather than the projects themselves. So you have to create the projects to assuage the demand. But when you look at, the third category, which is the growth category, which is dominated by middle market oriented investing, that number is extremely low. And so what that tells you is people who do run strategies in middle market growth oriented strategies are much more efficient at deploying their capital and are probably finding better value. And I'm sure that if we were looking at the performance statistics of growth, oriented investing, that we would find better performance as well. But that's just an assumption. Someone can prove me right on that, but I'm quite sure that we'll find that outcome.
So, just considering recent geopolitical developments, rounding out our discussion a little bit, what is your outlook for the future?
Yeah, I think we tend to forget that a lot of industrial activity around the world is a cross-border activity or parts of different value chains that transcend borders, that transcend jurisdictions. Very much like capital markets, by the way. We're somewhat agnostic to to borders, to not to trade, not to tariffs, but we are somewhat agnostic to where that activity per se is performed. And so what you'll find a lot of industrial players will do is to create, a broader footprint, to create subsidiarization in different parts of the world, to help try to find, local supply chains, localize the supply chains to avoid tariffs and trade barriers. But ultimately, it will lead a lot of companies, to try and explore a local footprint in a variety of other markets around the world. And so we, of course, look at the political landscape today, and you may have a view for or against that. Fundamentally, companies that are active in, across a range of different industrial activities will always find a way to perform their core activity, regardless of the environment. They just adapt to it. And this will be no different. So the current environment, the so-called trade war, which are coming, which have, one could argue, already started, will, I don't think, be an impediment. It's just going to create new supply chains, new value chains. It's going to create a new paradigm as well for some of these global multinationals, some of these middle market companies as well, to find new routes to markets, new efficient ways of working with the system and the reality of the markets that they're in.